Welcome back to another videos. Join us for the latest news, insights, and updates on the Iraqi dinar. Don't forget to like, subscribe, and share your thoughts in the comments. Let's explore the world of the Iraqi dinar together. The Iraqi dinar exchange and its tax implications have garnered considerable interest among investors, prompting many to seek clarity on this complex subject. Before delving into the details, it's essential to underscore that the following discussion is based on research and opinions, and individuals should conduct their own due diligence and consult with financial and tax professionals before making any decisions. The Iraqi dinar, as the official currency of Iraq, has long been subject to speculation and controversy within the investment community. Proponents of investing in the dinar often cite its perceived undervaluation and the potential for a substantial revaluation, RV, in the future. This belief hinges on factors such as Iraq's political and economic stability, its significant oil reserves, and support from the international community. However, it's crucial to note that there is no official confirmation or concrete evidence supporting these claims. Despite the optimism surrounding the Iraqi dinar, numerous experts and authorities have cautioned against investing in it, citing significant risks and potential fraud. They emphasize that the dinar remains a highly speculative investment, with limited liquidity outside of Iraq and strict regulations imposed by the Iraqi government and the Central Bank of Iraq. Therefore, investors considering holding or purchasing Iraqi dinars must carefully weigh these risks and challenges. One critical aspect to consider when dealing with Iraqi dinars is the tax implications associated with holding and exchanging them. The Internal Revenue Service, IRS, treats foreign currencies as property rather than money, subjecting transactions involving foreign currencies to the same tax rules as other asset transactions, such as stocks and bonds. The duration for which an individual holds the foreign currency before exchanging it determines whether the gain or loss is classified as long-term or short-term. If the currency is held for over a year, any resulting gain or loss is considered a long-term capital gain or loss. Conversely, if the currency is held for a year or less, it's categorized as a short-term capital gain or loss. The tax rates applicable to these gains or losses vary. Long-term capital gains are generally taxed at a lower rate compared to short-term capital gains, which are taxed at the individual's ordinary income tax rate. The exact tax rate depends on the individual's tax bracket, which is determined by their taxable income and filing status. For instance, in 2024, most taxpayers face a 15% tax rate on long-term capital gains, whereas short-term capital gains are taxed at their respective marginal tax rates, which range from 10% to 37%. However, certain exceptions exist, such as a 0% rate for low-income taxpayers and a 20% rate for high-income taxpayers. To illustrate the tax implications of an Iraqi dinar exchange, consider a hypothetical scenario where an individual purchases 1 million Iraqi dinars for $1,000 in 2020 when the exchange rate is 1,000 dinars per dollar. In 2024, they exchanged the dinars for $10,000 when the exchange rate is $100 per dollar, resulting in a $9,000 gain. If the individual held the dinars for more than 1 year, they would incur a long-term capital gain tax of 15%, amounting to $1,350. However, if the dinars were held for a year or less, they would face a short-term capital gain tax based on their marginal tax rate, which could be as high as 37%, resulting in a tax liability of $3,330. it's crucial to recognize that these figures are hypothetical and subject to variations based on market conditions, individual circumstances, and applicable tax laws. Additionally, factors such as fees, commissions charged by currency dealers, currency conversion rates, and foreign exchange regulations can impact the overall tax liability. Moreover, individuals must maintain accurate records of their transactions and report them diligently to the IRS to ensure compliance with tax obligations. Failure to do so could result in penalties or legal consequences. In conclusion, the tax implications of the Iraqi dinar exchange are multifaceted and can significantly impact an individual's financial outcomes. Given the complexity of the subject and the potential risks involved, seeking guidance from tax professionals is paramount to making informed decisions and navigating the intricacies of foreign currency investments. Thanks for watching Iraqi Dinar. Don't forget to subscribe, hit the bell icon, and share our videos. Your support keeps our channel going. Stay curious, and see you in the next one.